All right, so as I mentioned, the objectives are we're going to cover some new accounting standards updates. So there have been some new standards that have been released since we last met. We'll touch on those, and we'll also review some previous accounting standards updates that we have covered in prior sessions. We also want to take some time at the end to highlight some industry developments that we just thought was particularly noteworthy. So the overall outline is we're going to start with the ASUs that have been issued over the last 12 months, so since we last met in last November, then we'll talk about the next. We are going to focus on the audience at hand, so it's going to be more of a high-level overview. There's a lot of nuances with GAAP, as you all know, and we'd be happy to talk in more detail with anyone after the presentation, or we'll have our contact information at the end as well. We are going to focus on private companies, not public. That's consistent with every year, so if there's anything specific to public, we're going to exclude it from our presentation. We will also not seek to cover things such as IFRS or SEC, PCAOB matters. We're also going to limit our discussion on certain specialized industries as well, because we're trying to address the audience at hand at large. Okay, so this first slide we have with the table, it's going to illustrate all of the new ASUs that have been released since last November. So really it starts with ASU 2024-04, which was the last ASU issued in 24. And then there have been 7 standards updates issued so far in 2025. So that makes a total of 8. The 2 that are highlighted in red, so ASU 2025-01 and ASU 2025-02, those are specific to public companies. So we've included them here for completeness, just to demonstrate that we've considered all of the ASUs, but we are not going to talk about those 2 standards at all. But the other 6 we will cover. Of those 6, you might think, wow, that's a lot, especially compared to recent years when maybe there was only 4 standards updates, as in 2024. While there are 6 that we're going to cover, I would say probably 2 of them are more meaty. The others are kind of more scope or very specialized industries, but we will touch on them regardless. All right, so diving in, we're actually going to work backwards. So we're going to start with the ASU that was issued most recently, and I fact-checked this yesterday afternoon. So as of yesterday afternoon, this was the most recent standards update, and it is 2025-07. And interestingly enough, this standards update covers 2 what I feel like is totally unrelated topics. And it was issued just earlier this year in September. So it covers derivatives and also share-based non-cash consideration from a contract with customer. So we've broken it up into 2 slides here just to kind of make it more digestible. So the first piece is the derivatives. So the FASB received a lot of feedback that the definition of derivatives in ASC 815 was too broad, and as a result, there were certain things that were technically qualifying as a derivative under ASC 815 that just because they had contingent features, but they weren't actually a derivative, and the accounting for them as a derivative just made things more complicated and didn't really provide any value to the readers of the financial statements. So because of that and the feedback that the FASB received, they issued ASU 2025-07, which now creates a scope exception to topic 815, that if there is a derivative, if there's a contract with underlyings based on the normal operations of the specific entities, that it does not need to be accounted for as a derivative. So what that means is if it was tied to maybe obtaining regulatory approval or achieving a certain product development milestone, if it's tied to their operations, you don't need to qualify or account for it as a derivative. Again, this isn't very impactful to most of you, but I wanted to cover it nevertheless. So the next slide mentions the second topic of the ASU, and so that is share-based non-cash consideration. So the FASB also received a lot of feedback on this. There was diversity in how companies were accounting for share-based non-cash consideration. So, and that would be like equities or warrants that are indexed to the customer. Some companies were accounting for it under topic 606, just a part of the transaction price. in revenue recognition, whereas others were accounting for it under as a financial instrument, so either ASC 815 or ASC 321. So ASU 2025 clarifies that the share-based non-cash consideration should be accounted for under Topic 606. So if it is in the contract, you should consider it as part of the transaction price in determining the transaction price. If it is reasonably likely that it is going to be achieved or you're going to earn that, you should account for it initially as Rev Rec under Topic 606, and then subsequently account for it either under 815 or 321. So what does that mean, practically speaking? If there was a contract to sell a certain product and you know for X amount of dollars, but if you sell 1,000 units of that product, you'd be entitled to get a warrant from the customer for their tied to their share of stock. You would assess that and say, okay, what's the likelihood that we're actually going to achieve that threshold, that 1,000 units sold? If you believe it's likely, you'll factor it into the variable consideration at the onset of the contract and recognize it over time as the revenues recognized, as the performance obligations are earned. And then at the end, when you actually sell that 1,000th unit, so you earn that, then that's when you account for it under 815 or 321. The effective date and early adoption provisions are going to be on all the slides for the ASUs, so this is effective in years beginning after 2026, and early adoption is permitted. The next accounting standards update is ASU 2025-06, internal use software. So this was issued in September 2025 as well, and this is likely one of the meatier ASUs that were updated or were issued. So this serves to modernize the old internal use software guidance, which was based on more of a waterfall method, and adapted it to more of an agile basis, which is more in line with how software is actually being developed from a practical standpoint. This has been a topic of discussion for the FASB since June 2022. There was a lot of consideration of, hey, do we revisit the accounting for software development and have both internal and external under one methodology? And ultimately, this is where they landed for now. So they are not changing Topic 98520, which is the external use software, but they have made this amendment to ASC 35040, which is the internal use software. So under existing GAAP, there's, as I mentioned, the waterfall method. So you have to go to one stage, then once that's complete, you go to the next, and then you can capitalize, and then you go to the next, and you no longer capitalize. Here, this accounting standards update just strikes all of the mention of the different project stages, and instead you just apply the remainder of the literature. So what does that mean from a practical standpoint? It's not changing the costs that you're able to capitalize. It's not changing when you cease capitalization, but it is changing how you look at when you start to capitalize costs. Now, under the new literature, you start to capitalize costs when management has authorized and committed to funding for the software development, and it is probable that the project will be completed and the software will be used to perform the function intended. So that's the probable to complete threshold. You have to have both of those criteria to be met in order to capitalize the software costs. And if there's any uncertainty regarding the development, for instance, if the software has novel or unique aspects to it, or if there's significant performance requirements of the software have not yet been determined, you would not have met that threshold, so you would not start capitalizing it yet. This is effective for years beginning after December 15th, 2027, so it's still a little ways out, but early adoption is permitted.
I'll jump in here with the next ASU. So this is ASU 2025-05 regarding credit losses. The most relevant entities that this impacts is entities that have a large volume of short-term receivables. It principally seeks to reduce the complexity and cost in evaluating allowances as of a period end. For other entities, the guidance principally allows for intuitive ways of approaching an allowance to begin with. However, it does include provisions that those intuitive ways of looking at an allowance should be disclosed either if you adopt the practical expedient or adopt the accounting policy, which are practical expedient is you can assume conditions as of the balance sheet date do not change for the remaining life of the asset, or the accounting policy that may also be adopted is you may elect to consider subsequent collection activity. So this primarily affects companies with a large volume of receivables that you're looking through a lot of data and a lot of collections history. Where receivables are more limited, the impact is also more limited. So keep in mind just materiality through all of this. This is effective for years beginning after 12/15/2025, and entities may early adopt. This sort of echoes 2025-04 share-based consideration payable. This echoes similarly, though in a different way, Amber's earlier ASU 2025-07. So this applies to all entities that issue share-based consideration to a customer under a transaction that is within the scope of Topic 606. The primary intent of this ASU is to reduce diversity in practice and increase consistency in financial reporting of these arrangements. It is important to note that arrangements like this and those under 2025-07 are more seen in startups, tech or biotech or life sciences. You're more likely to see these arrangements in. As a general rule of thumb, if you start seeing joint development activities or any joint agreements along those lines, that should be sort of an indicator of, hey, should we be evaluating some of these other, the applicability of some of these ASUs and those arrangements. Obviously, it starts with if there is share-based consideration in such arrangements. This is primarily achieved through providing clarity and revising terminology around what is considered to be a performance condition in those arrangements, and it specifically highlights the impact of vesting under those arrangements and how that may impact the recognition. The next one is 2025-03, determining the accounting acquirer in an acquisition of a variable interest entity. So this affects all entities involved in transactions affected primarily by exchanging equity interests when that legal acquiree is a VIE that meets the definition of a business. So it is a mouthful. It's very specific. It is like most ASUs. The intent is to improve comparability between financial statements, especially when there's business combinations in those financial statements, irrespective of whether an entity that was acquired was a VIE or not, a variable interest entity. Some background. Prior to this ASU, the primary beneficiary of the legal acquiree was always the accounting acquirer, and this ASU essentially takes a step back and looks at broader factors, including governance, management, voting rights, and the nature of the entities to determine who should be the accounting acquirer in such a transaction, seeking to more closely portray the economic substance of a transaction like this. 2024-04, induced conversion of convertible debt. Here too, we have another pretty specific one, but again, it applies to all entities that settle convertible debt instruments for which the conversion privileges were changed to induce a conversion. The intended effect of this ASU is to improve relevance and consistency in the application of the guidance around convertible debt. The main provisions are to remove references in this subsection to equity and equity securities, seeking to further clarify that convertible debt may be converted into equity, cash, or other assets, or a combination of each of those, and the guidance around such should seek to portray the same economic substance of the inducement. Those are the primary provisions of this ASU. So pretty specific, but it does happen. It is around for sure. This is effective for years beginning after December 15th, 2025, and all entities may early adopt. Another one, so we're moving now to, the convertible debt was the first one that wasn't issued in 2025. So now we're looking back on the ones that we would like to highlight that were issued in prior years. So you have seen this, the Topic 718 on stock compensation. This applies to all entities that account for profit interests as compensation to employees or non-employees in return for goods or services. The primary intention of the ASU is to clarify if you have profits interests awards, whether those awards should be accounted for under Topic 718, which is share-based compensation arrangements, or Topic 710, which is general compensation that includes cash bonus or profit sharing arrangements. As background, what is a profits interest? Profits interests are not actually defined by GAAP, but they are defined by the IRS as a partnership interest other than a capital interest. So profits interests provide a right to a share of future profits, but do not provide a right to a portion of the net assets of an entity. The effect of the ASU is to, number one, to highlight that all of these arrangements, all profits interest arrangements, should be looked at on a case-by-case basis. So the way this ASU was framed was actually simply as an outline of a few cases, a few case studies or examples that they added commentary to relative to where these examples should fall, if the examples should fall into 710 or 718. So they did it sort of like contrast as the mother of clarity. They didn't provide any new sort of didactic phrase or prescriptive sort of direction, but rather went through it by providing examples through which you can, understand your profits interest arrangement and understand which topic that should fall under. So in general, there's a lot of different ways that people can be compensated, and you can see that is increasingly a relevant issue and topic of how do you account for all of these unique and creative ways to compensate employees, non-employees, sometimes companies. So you saw that there's 3 of the ASUs covered so far do consider share-based compensation. And that'll likely be a continued sort of trend as there's increasingly diverse ways that creative lawyers and compensation committees seek to compensate people for their efforts.
I'm glad I gave Austin this responsibility because it doesn't seem to be working well.
There it is. So yeah, apologies. That doesn't seem to be my strong suit, is the clicker. So next one is crypto assets. Again, this is not a new ASU, but it could be new to you depending on if you have held, or your entities, depending on if you have held crypto in the past versus now. So though it took some time for the FASB to come out and formally issue an ASU relative to how crypto assets should be accounted for, there's a little bit of, the percentage of entities that held crypto 10 years ago versus now is a big differential. So increasingly we are seeing that there are an increasing number of crypto holders, so it is becoming more and more relevant. So though this is Though this is not new, it could be new to you or in the future. In the past, the FASB has always, in accounting land generally, has always been a little bit skeptical of crypto relative to how it should be treated and recorded and what disclosures should be around it. So it did take some time for the FASB to determine and issue an ASU relative to treatment. Interestingly, the first thing of note is that it is not classified and doesn't fall under investments. It falls under intangible assets, and as such should be presented separately from other intangible assets on the balance sheet. Further, though the old methodology was, FASB before they got, before this ASU, it was hold the crypto assets at cost and evaluate it for impairment at least annually. Obviously, that didn't sort of convey the economic substance of crypto, given the volatility is, that's continued, but especially when this ASU was issued and prior. You'd see a lot of volatility, and it'd be very difficult to evaluate if the asset was truly impaired, even if it was down 70%, which truly could have been the case. So now it is measured at fair value, and all the gains and losses from remeasurement are included in net income. So again, because it is sort of the general public may consider it under the broad realm of investments, it is still distinct under the codification. And part of that distinction is obviously there's a lot of disclosures relative to holdings of investments. Similarly here, there's a lot of disclosure requirements relative to the holdings of crypto assets, and even more so for the nature of the asset. So some of those more detailed disclosure requirements include the names of the crypto assets held, the cost, the carrying cost of the crypto asset, the fair value, even down to the number of units held. Further, the disclosure requirements include a full roll forward of all crypto assets. Some other considerations beyond just the how to report for crypto. Some other considerations also include what does it look like for an entity relative to sort of governance and oversight and fiscal responsibility relative to crypto assets held. So if you're a nonprofit, how do you kind of getting out ahead of the discussions of are we set up to receive? Do we want to receive crypto assets? If a donor indicates an interest of giving crypto assets, do we want to receive it? Are we equipped to receive it? Do we have the appropriate custodial relationships in place and the accounts in place to receive such assets? Again, you see it most for nonprofits. If you do receive it, what's the intent of the entity relative to the holding period of the asset? Many nonprofits liquidate investments upon receipt. Similarly here, is there an intention to hold it for a period of time, or is the intention to sell upon receipt, liquidate upon receipt? And then again, more broadly, who's responsibility of monitoring this new asset class? So I think the largest thing to take away from this is kind of splitting it mentally from strictly investments. The FASB does very clearly classify it as an other asset, not an investment. We'll turn it over to Amber back.
All right, so next we have 2023-09, which was a standards update issued related to the income tax disclosure requirements. So we did cover this last year, but we want to rehash it again this year, especially since it's going to take effect for public companies this year, private companies the following year. So the purpose behind ASU 2023-09 was to enhance the transparency of the income tax disclosures. So really, it's not changing how you account for income taxes, but it is going to expand the disclosures. The FASB had this on their technical agenda to revisit the income tax disclosure since 2015. So this has been a long time in the making. And the feedback that the FASB got from investors was that there was not enough transparency in the disclosures in order to address global tax risk. So ASU 2023-09 expands on the disclosures, and there's really 3 different disclosure requirements that are going to be new. So there's a rate reconciliation disclosure, which has always been a required disclosure. If there's a difference between the income tax as recorded versus what you would expect based on the statutory rates, you would have to disclose the nature of any big items that are causing that difference. But it was a little bit vague, the requirements for that. Now there's very explicit things that you need to disclose. Public companies are even more intense than the disclosure requirements for non-public companies, but you need to essentially disclose the impact of certain reconciling items, such as tax credits, changes in valuation allowances, non-taxable or non-deductible items, etc. And if there's anything that makes up over 5%, you actually need to have expanded disclosures on that as well. So it's just really taking the rate reconciliation, which is something we do when we prepare an income tax provision for a client. We already do the rate rec, well now you have to formalize it in the footnote to the financial statements. And another aspect of that is that they're looking at, and they want the readers to understand by jurisdiction. So you have to add enhanced disclosures regarding what was the federal tax versus what's the state and local taxes. The next disclosure requirement is for income taxes paid. So now you're required to disclose income taxes paid, net of refunds, disaggregated by federal, state, and then foreign. So really, you were always required to disclose income taxes paid, but now you have to break it down by which jurisdiction you are paying. And then finally, there's 2 other disclosure requirements. So now you are required to report pre-tax income between domestic and foreign entities, and then also the income tax expense between between federal, state, and foreign taxes. So as I mentioned, these enhanced disclosures are going to go into effect for public companies at the end of 2025, except, drum roll please, if you're sleeping and you want some drama, you can wake up now. The current administration actually has stepped in and has threatened to revoke the FASB funding if they don't overturn this ASU. So the argument that the House Appropriations Committee said, so they actually put in the budget that none of this money is allowed to go to the FASB unless they rescind ASU 2023-09. And their argument is that it's by adding these enhanced disclosures, you're sharing proprietary information with your competitors. They actually went as far as to say foreign competitors can, steal that and then steal the business and move the business from America to foreign countries. And they also fear that it will cause taxing authorities to have heightened scrutiny on certain companies if there's enhanced disclosures. So that is why they are pushing to not have it go into effect. As far as we know, it's still set to go into effect at the end of the year for public companies. I think with the political environment we have right now, a lot can happen, a lot can change. Who knows where it's going to land? I think the initial, how the House appropriation, their initial bill passed with the language in it as it read, so not really sure what's going to happen, but that is some exciting accounting news. So I'm sure you didn't think, it was not on your bingo card that the administration, the president, et cetera, was going to be concerned about an accounting standards update. But here we are. So stay tuned. If it does go into effect, we'll be prepared to help you. It truly is just enhanced disclosure requirements. And honestly, whether it's us or you preparing your income tax provision, you already have the information there. It's just putting it into footnote format. So no worries if it does go into effect, but who knows. The next accounting standards update we want to highlight is ASU 2023-05, which pertains to business combinations and specifically joint venture formations. So I'm just going to very high level speak on this since we have covered it in greater detail in prior years. But there was diversity in practice with how how things were being assigned to joint ventures upon formation. In some practices, they were assigning it based on fair value. In others, they were using historical cost. So if something was transferred over to the JV at formation, they would use historical cost. This accounting standards update clarifies that pretty much the formation of the JV should be accounted for as at fair value, just like any other business combination. So because of that, not only do you now have fair value reporting for it, but there could also now be goodwill upon the formation of a joint venture, whereas if you were using historical costs, that would not be the case. And this standard is effective for JVs formed after January 1st, 2025, so this year. We also have ASU 2022-03, which is fair value measurement. And under 820, when measuring fair value, an entity must consider characteristics that a market participant would consider in order to determine the measurement, the fair value. And there was a little bit of confusion or uncertainty regarding whenever there's a contractual sale restriction. So ASU 2022-03 just amends that to say that the contractual sale restriction essentially shouldn't play a role in determining the fair value. And this went into effect actually this year for non-public entities.
I will say on the ASUs getting a broader government interest, it is good. We should probably celebrate that the government shutdown ended, I think, yesterday or today, one of those times. So probably back to evaluating ASUs potentially, and then maybe we'll see it as a point in the next election. So we'll see. But we'll move to other potential changes on ASUs, and then we'll transition to broader industry developments beyond just GAAP and how to account for things and present things. So exposure drafts, no exposure drafts currently open for comment. Recent topics have included paid-in-kind dividends on preferred interests. The comments on that were due October 27th of 2025. Accounting for debt exchanges more broadly, comments for that were due May 30th of 2025. And then also there is a recent topic has been accounting for environmental credit programs, which an ASU is currently being drafted for a vote for that one. Current FASB projects generally, so one is accounting for environmental credit programs is a current project of FASB. It is gaining relevance, and users don't really have clear guidance on the accounting implications for those. A second is accounting for government grants. That may seem a little bit sort of late. In general, the FASB has not been direct on accounting for these government grants. And thus, most accounting for government grants has been done by analogy to other topics. So it is a project of the FASB to be clear and specific relative to government grants. Software development costs. So earlier, Amber discussed the new ASU relative to internal use software. That falls under the umbrella of the broader ongoing project for the FASB to update guidance relative to software development costs. The primary driver for that is, as Amber mentioned earlier, 20 years ago, software development did look like more methodical, more linear, more waterfall method where you had very clear stages of development. That really has been sort of an out-of-date methodology, or generally speaking, that's not what you typically see for software development in the current stage. So anytime you're talking to software developers, they are primarily talking about an agile environment, an iterative process, where sort of like move fast and break things methodology or sort of MO is the MO of many software development companies. So GAP is still catching up to that process of the more, the versions, the continuous effort of developing software, where you not only have, a version 1.0, 2.0, but you have 1.0, 1.1, 1.2, and even broader than that, where you have just sort of ongoing improvement to software. Another one is classification of certain digital assets as cash equivalents. So this is as would be expected in the evolving landscape of sort of this new asset class. We talked about crypto earlier, and crypto is not the only sort of new asset class on the market, especially the digital market right now, with things like non-fungible tokens and the like. There's a lot there that the FASB is still sort of like developing guidance on. Taking this like a moment to pause and look at these projects and like the ASUs that we've discussed thus far, always keeping in mind that, hey, why do we have ASUs to begin with? Why are there projects? Why do the FASB have projects? It is always driven by an evolving business environment and evolving economic landscape, with new and more and unique transactions taking place, new and unique assets, and new and unique arrangements, period. Like environmental credit programs, all things digital assets, and similar. So in general, just an appreciation for, hey, the FASB's job is to ensure that GAP is designed to enhance decision usefulness, improve comparability in financial statements, and communicate the economic reality, the economic substance of underlying transactions. So, as activities evolve, so also will GAP evolve. So we're moving out of U.S. GAP, strictly out of ASU territory, and now into just broader industry developments to be aware of. The first is keeping pace with AI. So the language of AI, as everybody sort of evolves and gets their arms around rapidly developing technologies, sometimes it's difficult because the language can be thrown around so much. Just last week, I was using my air compressor to fill my air in the tires of my car, and I noticed that the air compressor had sort of the title of AI. It was an AI air compressor, and I was like, oh, that's like seems a little bit like a stretch so the general slapping AI onto things that have existed, onto technologies that have existed for decades, is a little bit confusing to the broad public. So that is difficult. You can err in the side of, oh, well, everybody's just slapping AI onto things that have existed for decades. But there's also a risk of underappreciating the true advancement of the technologies. Some have said that large language models are just a glorified like autofill. Or just a more advanced autofill, like, even 10 years ago, our iPhones were kind of predicting the next possible word for our texts. But that does understate it. To think it's just a better autofill likely does understate the technology underlying the large language models. Another thing too is technology, just thinking about technological advancement in context of human history. One, it is always difficult to predict the actual impacts of technologies. So like the classic example, or like story or analogy is Jurassic Park of, hey, you have this new technology, you think it's like contained, you think it's going to operate this way, but when you actually release something into the wild, so to speak, how, with all the variables, all the factors, all the humans out there, we don't really know the impact, or it's very difficult to predict the actual impact of a technology released into the wild. So generally speaking, just an awareness and appreciation for humility of I am not exactly sure how this new technology will impact things, including what use cases do customers or do users have an actual appetite for. I know that most grocery stores we go into nowadays do have sort of the self-checkout lane, sort of the automation of that and the self-checkout lane. But there are still portions of, I haven't been to Trader Joe's in probably 2 years, but my understanding is Trader Joe's still does not have self-checkout lanes. So there is a little bit of, we may predict that something will replace a human in a process, but there is a sense in which we don't know exactly what the appetite will be or exactly what the use case will be. In general, some things are pretty clear and some things are less clear. In terms of the broader business environment around AI, adoption does vary. Broadly speaking, most people can benefit from simply automation, which computers have been good at for a long time. Computers have been good at sort of reading a rules-based logic and applying a rules-based logic to in a certain context or task. So the realm of automation is still sort of a realm where there's a lot of low-hanging fruit that hasn't been fully capitalized on, versus, sort of we're seeing more, obviously people are increasingly talking about agentic AI, using agents, using bots to sort of go out there and make decisions and not do the rules-based so much as sort of trial and error decisions. And then broadly, principles for usage and experimentation. Getting actual experience with a large language model, if you haven't just like pulled up ChatGPT or Copilot or similar, is helpful to actually, we hear about AI so much, but like actually getting fingertips on these technologies, and particularly large language models that have had a very rapid development over, the past handful of years. Getting actual fingers on it is helpful, because then you can visualize. Broadly, it's difficult to know the barriers or the capabilities of large language models until you've actually touched, until you have actually used them. And the barriers of what a large language model is good at versus not good at aren't always clear. It's not always clear. It's not always as you would think. It's good at something that you think it would be bad at, and it's bad at something you think maybe it would be good at. But obviously in all of this, a principle for usage and experimentation is being mindful of data protection in anything, including any experimentation with large language models or other AI programs. Back to Amber.
All right, so the accounting pipeline has been a hot topic in recent years, and we wanted to, revisit this in light of the bill that passed in June of this year. So PA finally took, I think, a pretty big step forward to helping to revitalize the CPA profession, help to, spark interest in maybe some of the younger generations. So Act 27, which was formerly known as PA Senate Bill 719, was signed into law on June 30th of this year. It had unanimous support by both the Senate and the House, so it was really a bipartisan display of support for the accounting profession. And the legislation updates the CPA requirements, offers greater flexibility for candidates, and increases workforce mobility, and really aligns PA with some more modern career pathways. So I think that's particularly relevant when you think about hiring, when you think about succession planning, stuff like that. When we looked at the industry, we saw there was a clear concern about the number of accountants entering the workforce, and so hopefully this will help revitalize it. So under the previous guidelines, and I think this went into effect, I remember being a freshman in college, so 15 years ago or so, where they introduced the 150 credit hour requirement. So you could become licensed in Pennsylvania if you had 150 credit hours, you passed the exam, and you had 1 year of work experience. The other alternative was to have a bachelor's degree, 1 year of experience, and passing the CPA exam. So that was historically, over the last 15 years or so, the options to get your license in Pennsylvania. Now Act 27 introduced a third option. So if you have your bachelor's degree, pass the exam, and have 2 years of work experience, you can now become licensed. So that really created flexibility for those candidates who simply don't have 150 hours, maybe they don't have any intentions of going back to school, or maybe they're in school and they're just like, hey, that's a heavy lift, because normally you can get your degree with around 120, 124. So to take on the additional credit hours just didn't seem worth it to some of the younger generations. So now we have this third option, and really it seems like a no-brainer. If you're gonna go into the profession, all it is 1 more year of work experience, and then you'll get your license. You're gonna be working regardless. So it's really opening up a pathway for new candidates in the profession. Other relevant factors that came out of this act would be that reference hours are no longer, reference letters are no longer required in most circumstances. And so the thought was, you used to have a reference letter from CPA, but then you also have to get your work experience certified by a CPA that you worked with. So they recognize that's a little redundant, and sometimes it is administratively difficult to get a reference letter from someone. So in most cases, they've eliminated that requirement by just having your work experience. You're essentially being certified that you were in the profession and you were qualified. There is also an extension to the testing window. So previously you would have 18 months to pass the exam from once you got your first credit. You have 18 months to get your remaining 3 credits. Now they've extended that to be 30 months, which is more in line with a lot of the other states across the country. There's been kind of a uniformity to allow that flexibility. And this actually went into effect for any unexpired credits at the date the act was signed into law. So as of June 30th, 2025, if you had a credit that wasn't expired, you have the 30-month window now. There is also formal recognition of automatic mobility now. And so really that just allows CPA practicing over multiple state lines. So if you have a license in another state and you meet the requirements of the Pennsylvania CPA designation, you can practice in Pennsylvania. You don't actually have to become licensed in Pennsylvania. So that's a pretty big win. The things that haven't changed would be sitting for the exam, the professional experience, and PA still has the requirement that 24 of the credit hours are in accounting and related industries. We are out of time, but the remaining 2 slides really just focus on retirement plans, the DOL update. It's not new, we just wanted to include it in to serve as a reminder of the new participant count rule, specifically because the Secure 2.0 Act, which is the final slide, introduces a lot of provisions that are intended to increase participation in the plan. So while the new participant count rule initially resulted in some plans qualifying as a small filer instead of a large filer and no longer needing an audit requirement, Secure 2.0 is really intended to boost participation in many cases. And so it's possible that while you are not subject to an audit requirement now, over the next couple of years, your participation levels may increase and you may be subject to an audit requirement. As always, thank you for allowing us the opportunity to present. Here's Austin and I's contact information. If you have any questions, want to discuss anything further, we'd be glad to do so. But thank you.